But anyway, that's a conversation for another day.
And I think this all boils down to one word, and that is control.
Yeah.
When we pay taxes, we lose control of our money.
Yep.
We just finished talking about how debt, because of the debtor's prison, we lose control. We lose control of our money. We're paying our money in the form of an interest rate to somebody else.
Yep. All right. So basically, the individual is stuck with a 5% savings rate. Okay. So what's the solution to get more money? Now, 5% is higher than the average. It's a lot higher than the average. Average is like 1. So this is like 400% higher.
Yeah.
So anyway, we won't get into that. So let's look at what the average solution is for the American. The average solution is, okay, we'll walk into Edward Jones, or we'll walk into Charles Schwab. Hey, 5% of your income? Pfft, awesome. You're saving above the national average. What we can do so you have more money in the future is we can earn a higher rate of return. Now the individual's capacity goes to $4.4 million, right? Savings goes up to $221, which is really good, but look at the capacity. You basically lose $4.2 million to wealth transfer. Insane. Okay, all right, so 10%, obviously this is unrealistic. Now what's cool is that you go back to, the 90s, all right? We can go into a little calculator here to show this. But you go back to the 90s, and the 90s did pretty well. Right? 90s did pretty well. Look there was only one losing year in the 90s. Right here, bang. But look at what happened to all the gains. All these gains, bump, 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 and then boom, boom, boom. Consistency as far as rate of return has never existed in the market, ever. Because you've always had booms, and you've always had busts. Right? So 10% every year for 30 years, not very likely.
No.
Okay? All right. Unless you're, George Soros.
Warren Buffett.
They know what they're doing. So that's unrealistic. So let's go back to 5, right? 5%. So how do you solve the problem? How do you solve the problem? Right? You solve the problem by plugging up the money leak. That's it. So as I stated before, we work with a lot of real estate investors and business owners, and they understand how to utilize LLCs and S Corps and C Corps and other entities to help them avoid these money leaks or these wealth transfers, right? And they use legal and ethical practices with their accounting to lower their tax liability, okay? Because a regular employee, let's say we have a regular employee that works for the post office, right? He gets up in the morning and brushes his teeth, right? He puts on clothes. He takes a shower. Right? He drives in his car and spends gasoline on doing so. Okay? Those are operating expenses, so he can go to the post office and earn a living and pay taxes, right? Does the IRS acknowledge those as operating expenses?
Negative.
Negative, right? But for the business owner, if he has to buy materials, right? If he has to invest in this or he has to invest in that, right? Or he has to use a vehicle to operate his properties or manage his properties or upkeep his properties, guess what? Operating expenses. Right? So let's lower the total taxes to, let's say, just 30%. Look at what happens to the 96 with just taking 10% away from taxes and back into your pocket. 288. You will have more money than earning a double-digit rate of return, okay, by just lowering your tax liability for 10% and taking the transfer of wealth from you and putting it back into your pocket. All right. Debt service. The infinite banking concept, we do not use third-party debt. We use your own monetary system. So let's say we wipe out 20% there.
Wow.
673. Right? That's going to take 10, 15, 20% rates of return in the market to do that on a 5% level. And then lifestyle. Let's say instead of, buying your furniture with credit or buying your furniture with cash, right? You utilize the banking concept and just took down your lifestyle by 10%. Okay? So this is the impact of proper macroeconomic financial planning. When you take into consideration your money leaks and you plug up the money leaks. Financial planning is not about earning stupid rates of return, right? Because we all know where that goes. It all goes to speculation, and the byproduct of speculation 10 times out of 10 is loss. Okay, so what this illustrates is just kind of putting some numbers on a spreadsheet and just showing you, how to recoup your money leaks and how to do so in a conservative manner. And guess what? All of this was in your control. The 10% in your mutual fund or in the market, you had nothing to do with that. Nothing. All right, this is Patrick and Michael signing out. We'll talk to you next week.